Imagine you could double or even triple the daily returns of your favorite stock market index. That's the alluring promise of leveraged ETFs. These investment vehicles magnify the daily performance of an underlying asset, like the S&P 500 or a specific sector. But with amplified returns comes amplified risk. Leveraged ETFs use financial derivatives and debt instruments to amplify their returns. For example, a 2x leveraged ETF aims to return 2% for every 1% gain in the underlying index. However, this leverage works both ways, amplifying both gains and losses. This makes leveraged ETFs significantly riskier than traditional ETFs, especially for long-term investors. The allure of leveraged ETFs lies in their potential to generate outsized returns in a short period. For investors seeking to capitalize on short-term market movements, leveraged ETFs can be an attractive option. However, these amplified returns come with a corresponding increase in risk. Leveraged ETFs achieve their returns through financial derivatives, like futures contracts and options. This leverage magnifies both gains and losses, making leveraged ETFs highly volatile. While they can deliver impressive returns during a bull market, they can also experience significant losses during a downturn. The daily reset mechanism of leveraged ETFs can exacerbate losses over time. This can lead to a phenomenon known as volatility drag. Let's illustrate the mechanics of leveraged ETFs with an example. Consider the ProShares Ultra Pro QQQ or TQQQ, a 3x leveraged ETF that tracks the NASDAQ 100 index. If the NASDAQ 100 index rises by 1% in a day, TQQQ aims to deliver a return of 3%. Conversely, if the index falls by 1%, TQQQ would experience a 3% loss. Now imagine the NASDAQ 100 index rises by 2% one day and falls by 2% the next. A traditional ETF would end up roughly where it started, but TQQQ would incur a net loss due to the daily reset mechanism. This example highlights the impact of volatility drag on leveraged ETFs over extended periods. Inverse leveraged ETFs aim to deliver the inverse of the underlying asset's performance, amplified by a leverage factor. Leveraged ETFs offer potential benefits for certain investors, but they are not suitable for everyone. Pros: amplified returns. They can generate outsized returns in a short period. Short-term trading opportunities, valuable for experienced traders seeking to capitalize on short-term market movements. Accessibility and diversification. Traded on major stock exchanges, providing easy access and diversification. Cons: amplified losses. The leverage that magnifies gains also amplifies losses. Volatility drag. The daily reset mechanism can erode returns over time. Complexity requires a thorough understanding before investing. Given their high-risk nature, leveraged ETFs are most suitable for experienced investors with a high risk tolerance and a short-term investment horizon.